The Middle East's first unicorn has finally turned profitable after many tumultuous months that threatened to get the startup delisted from Nasdaq last year. Egypt-based mobility company SWVL, which turned the expensive facade of Burj Khalifa red in August 2022 to celebrate its $1.5 billion listing, saw its profits, stock prices, and valuation tumble drastically last year. Why? Global economic factors, including rising interest rates, Russia-Ukraine war, Egypt's currency devaluation, as well as SWVL's decision of prioritizing growth over efficiency. However, a range of changes and corrective measures has resulted in the company reporting a net profit of over $3 million last year. We caught up with SWVL's founder to learn more.
We had to take a very hard look on everything that we're doing, and we had to almost categorize basically profitable and non-profitable almost. We just took a very ruthless, very aggressive call, unfortunately, to basically say, okay, just today we're going to focus on being profitable. And then once we have a profitable core markets, we're going to use it to expand into other markets.
SWVL was on an expansion spree in 2021-22 and acquired companies across Latin America, Mexico, Europe, and Asia. Today, they've either sold or divested from these markets with the aim to focus on Egypt, Saudi, and the UAE for now, and then relaunch in developed markets later.
We've done well in the expansions, actually. Like, we've become a household name almost from Argentina to Pakistan, and almost everywhere in between. And even before these restructures, we were almost breaking even from a P&L perspective. We needed a few more months to be profitable on cash flow wise, but the problem was that I think we expanded before getting the money, and that was the biggest mistake. I think what we will not do again is expand while waiting for capital or things like that.
Today, SWVL's market cap is around $77 million compared to $1.5 billion when it listed, and its stock price is nearly 95% below its peak. But Kandil still claims it was not overvalued.
Our growth we've been growing at a CAGR of 200% every year, right? We started in 2017, we did barely $100,000 of revenue. 2022, with almost 3 months gone into this restructure that we've done and this portfolio optimization, we've done close to 90 million. That's with 2 years of COVID. So in 5 years, going from 100,000 to 90 million was 2 years of COVID. So I don't think it was, like, if you think about it, like in hindsight, you can say, yes, compared to today, definitely would be, things are different. But at that time, in that circumstances, with these interest rates that were there back then, with these comparables, with that growth rate, I don't think we were overvalued at all.
Was listing on Nasdaq perhaps a bad idea then?
I say this in my head every day. I think, as they say, hindsight capital is the best investor ever. But I still think that actually listing on Nasdaq, this is the deepest pocket in the world. This is the deepest financial market in the world. Our story will be in the US at some point, so definitely, and the US will be a big component of the story. So it definitely makes sense. If you look at any other market in the world, it's either very low liquidity or it's not as deep, right? Let's be clear. Very few kind of capital markets in the world are as global or as deep, right? There was no private capital available, and the only way to raise capital was actually going public, which we've done. So if I'd go back, I'll do exactly the same, right? Because there was no really other option. And still, we were not at a scale that can allow us to turn profitable at that time.